You spot a solid double bottom on your chart. You place your buy order, set your stop loss, and watch as the price approaches your line. But instead of bouncing, it breaks, plummeting right through your stop loss, before instantly rocketing in your original direction. This phenomenon occurs because standard support zones function as structural liquidity traps. Our objective is to stop you from acting as retail liquidity. We are going to map out a secure trade using institutional entry models. Open your charting platform. We are going to walk through a specific real-world example from start to finish. Aligning your entries with institutional order flow protects your capital. It turns frustrating losses into setups designed to capture liquidity from others. We are looking at the euro to Swiss franc on a 5-minute time frame. Our first step is evaluating the initial demand zones within this upward trend. Notice the gap beneath these two demand zones highlighted in yellow. This imbalance is where price moved too quickly, leaving unfilled orders. Large players target this, knowing retail stop losses sit below. Therefore, you must immediately disqualify these zones. Mark them as false signals. These zones are incredibly tempting. To an untrained trader, they look like textbook setups to buy into. This is an inducement. It is a structural mechanism designed to draw premature buyers into a position engineered to fail. Any demand zone with an imbalance directly beneath it should be ignored for an entry. Filtering out the inducement is your first line of defense. It saves you from taking predictable losses before the real move even starts. Now, direct your focus further down the chart. We need to locate the absolute lowest point of the current move. The lowest demand zone is outlined in green. There are no gaps beneath the lowest candlestick wick. Unlike earlier traps, this clean structure is our only valid point of interest. This efficient range means institutions have no structural reason to drive the price lower. Identifying this extreme zone isolates the actual institutional starting line, insulating your trade from the volatility of the retail traps above. Even with the extreme zone identified, do not place a blind buy order yet. Wait as price action falls, breaking through the early inducement zones until it taps our green extreme zone. It must bounce upward with enough aggression to break the previous lower high, shattering that structure. This fracture is the standard confirmation, proving market direction has changed. If the price taps the zone but fails to break the structure above, the existing downtrend remains intact. Having the patience to wait for this shift eliminates the danger of trying to catch a falling knife. The standard confirmation provides the structural evidence needed to prove that institutional control has shifted. Now that the shift is confirmed, identify the new, smaller demand zone created during that aggressive push upward. This mock-up maps the trade. Take your long position tool and set your entry level precisely aligned to the top of this new demand zone. Set your stop loss safely underneath the lowest wick of this zone and target the structural highs for your take profit. Executing the trade here relies on verified market momentum. It ensures the risk-to-reward ratio is skewed in your favor. Here is the final outcome. The price dips back, triggering our limit order at the entry zone before rising steadily to hit the profit target. Contrast this execution with the retail trader who bought the early support line and was liquidated at the inducement. The framework is consistent. Identify the trap, locate the extreme range, wait for confirmation, and execute the limit order. Open 3 different asset charts right now. Hunt for equal highs or lows and practice mapping out this entry model. Mastering this sequence ensures you are no longer the market's liquidity, but a trader working alongside the architects who engineer it.